Hello, listeners. You're listening to part two of a two-part series. Enjoy the episode, and we'll see you soon.
Okay, so question number 3. What causes a really huge decline in stock? I think we already talked about that a little bit.
We did, yep. So it was
Yeah.
kind of interweaved in the other one, but
Okay.
this goes back to if you're sitting in the classroom in the in the
Yeah.
academic environment, they have models, and that's what academics are about. It's models and ways
They're
to
trying to,
describe
yes.
the world, to understand the world, and what happens. And models are not perfect.
They're not even close.
Yes,
You know?
we've seen that in many instances
So many.
in the financial world, for sure. But they're an attempt to understand the world and how things work. And again, in any financial asset, whether it's a bond, a piece of real estate, a business, a stock, it's a function of the cash flows. If you're going to buy a business, you're going to pay for the some price based on the income stream it generates. But I think the key thing here for any investment is, like in this context, let's say a stock, a publicly traded company hopefully generates profits, although many of them don't. But you're paying for that, and you're also adjusting that for the risk.
Right.
And when you look at the stock market and people are watching TV and it's gyrating up and down every day, well, in essence, it is the consensus view that is constantly reassessing the profits and the risk of those profits. And essentially, new information comes in every day. Just think about the past month.
I was just going to say, let's look at what's happened now, right? With the war, right? Nobody saw this war coming. Look what happens to stocks. They go down because oil's pricier, gasoline's pricier, consumers going to be stretched. They're not going to be able to buy as much stuff. So it's going to be really interesting, the fallout from all of this. Inflation's probably going to heat up. The Federal Reserve is not going to be able to cut interest rates, may not be able to. God only knows what they're going to do.
Right.
Nobody can anticipate that. I think that this topic number 4 is fascinating because what we don't realize is how often a decline occurs and what the probability of a 20% loss. Like most people think 20%, that's an average bear market. Really, an average bear market is closer to 30%. But let's just take 20% because that's the definition of a bear market, right? So I think it's fascinating. The odds of a 20%, the probability of a 20% decline over 10 years is, for U.S. stocks, is close to 25%. But over the longer term, the end of the time period, it's down to 1.77%. So the odds of you really losing money in a broad, diversified portfolio are pretty low, relatively speaking. But the odds of losing money in an individual stock are huge. Just like we said, 60% of stocks lost money.
Yeah, so I think that that goes back to that timeless axiom of buy and hold. And I think when you think about the stock market, to your point, that's why we build a diversified portfolio. A broad basket of stocks is a good long-term investment. It's just unpredictable over the short term. So you can easily experience 20, 30% declines, but over a long enough time horizon, the likelihood that that portfolio is going to lose money, at least historically, has been very, very low.
And look at the probability of losing 20% in a 70% equity portfolio with 30% in bonds, right? Over 10 years, it's down to 12%.
Yep.
And over the long term, it's like not even 1%.
Yeah. So again, diversification it reduces the severity of the decline and certainly the likelihood of a permanent decline. But go back to some of those studies, like the Bessenbinder study. That's a lot different than a broad diversified portfolio. There, 60% of individual stocks are net wealth destroyers.
You lose money. My goodness.
Yeah, there was another study out there. I apologize. I forget the reference here for the proper citation. But if you look at the Russell 3000,
I saw that too.
Another broad index of stocks, I believe it was 40% of the stocks in the Russell 3000 suffer 70% declines that are never recovered from.
Right. Permanent loss.
Yes.
Permanent loss.
Yep.
And that's the problem because people hold on, because it's going to come back. It's going to come back. Okay, when? And what is the cost of you doing that versus having it invested somewhere else in a broad, diversified portfolio?
But I think it drives home the point, we diversified to try and minimize the risk. But the reality is over time, as long as you have diversified properly, the likelihood of a long-term loss is very low. But if you own a single concentrated investment, then obviously the odds there
go
are
way up.
quite a bit different.
You know what's interesting, Eric? What I find is that people tend not to remember what they originally paid and the fact that it's gone up, 10% a year. They just look at what it was the last time they looked at their statement, and they're freaking out because it's down so much.
Yeah, you know what? And I think you're onto something there. And I think it comes back to this anchoring bias, if you will, is that, a lot of times, especially when things get volatile, people are always relating their current balance to the last highest peak.
Exactly.
And, if anybody looked at a stock chart, if you get close enough, you'll see that it's always kind of 2 or 3 steps forward and 1 step back.
Yeah.
It's peaks and valleys, but over time, it's rising. But yeah, and I think that unfortunately triggers that response to think, I should be doing something.
Right.
I should be changing or altering.
Right.
And that's just the natural
worst
course.
time to do it. It's like it's completely different, but like what we talked about with longevity and vitality planning. What happens is we get a call in the midst of the crisis and people are making emotional decisions because they don't know what to do. They're really worried. They've got to find a place, find a bed for somebody. They don't know where to go. That's not the time because what happens is they're spending a lot of money unnecessarily or they're not being able to provide the care and the comfort that they really would have wanted to. Yep. So it's the same thing here. I mean, we just plan it. Just plan it out.
Yep.
So let's talk about strategies.
Okay, sounds great.
There's four strategies for stock positions. Let's go over them. Let's start with selling.
All right. So let's, I think the way these are kind of arranged, at least for those that are listening to the podcast, start out with the easiest, most practical solution, and gradually we add complexity, just so people know what's on the menu here.
Yeah.
But ultimately, I think once you see the complexity and what's involved, hopefully we come back to the practical solution, which is the easiest way to address the issue is to commit to reducing the risk by selling. So, to your point, we went back, which is, kind of a gradual or stage sale. Some people we find might be in a phase of life where they can actually get the 0% capital gains rate.
I love doing that.
So that's a great opportunity, but
out there.
Kind of requires a unique set of circumstances. Excuse me. But again, if we're going to sell, we want to be thoughtful about how to generate the most dollars, least amount of tax. So that's where some of these tax lot methodologies come in, like LIFO or the max loss, min gain strategy that you can select. Other things you can do as well is maybe just sell covered calls.
Okay, let's explain how that works. That's a synthetic dividend I was referring to earlier. Yep. So let's walk people through how that works.
Yeah, so if people are kind of committed to holding a core position for some period of time, even if you're just gradually peeling off shares, you can go into the markets, derivative markets, and I know that's kind of a scary place.
Yep.
But essentially, call options are provide a right to acquire a stock at a certain price. So if you hold the stock, you can sell another market participant the right to buy the stock at a certain price.
Okay, let's go through an example. Right. Let's say that I hold 1,000 shares of IBM, and I want to sell a call. Right. Okay, so you want to buy IBM at some point. You'd like to buy it at a particular price. So I sell you the opportunity over the next 6 months. I don't know what IBM is trading at today, but let's say that if IBM goes up 20%, okay, you're willing to pay a premium for the opportunity to buy IBM at a pre-agreed upon price, right? So that's all it is. In the meantime, because I've sold that, you're paying me a few $100 just for the privilege of being able to be first right of refusal. You get to buy it, right? Yep. And get the difference between what you're paying for it and what it's currently trading at. So the risk that you have with selling cover calls, it's probably the safest option strategy out there, is that I lose the 1,000 shares, right? But isn't that sort of the point anyway, is to diversify out of a concentrated stock position?
Yeah, so it's just important to remember what you're really doing is just kind of putting a ceiling on your opportunity.
Right.
To the extent that you're selling these calls, but for people that have some belief in the company or they're going to sell it over time, not all at once, just gives them a way to create some additional income. But
Mhm.
it also sets a selling price above where the current
Where
price
yeah.
resides. So it kind of commits you to selling at a certain price, which is kind
A
of what you
great
wanted to do.
discipline anyway. Yeah.
Yeah, anyway, but the main thing here is it does not protect from a catastrophic decline on the downside.
That's a good point. That's
so
a really important point.
yeah, so that's kind of where hedging comes in, which that's one of the strategies we're going to get to.
Mhm.
But I also think we come across a lot of people where they have a concentration in stock via their employment.
Yes.
So because of their position, their compensation essentially provides their remuneration through shares.
Yes.
Through options, restricted shares, things like that. And if you happen to be an insider where there
Yeah.
are blackout periods,
You can't do anything.
yeah, then you're subject to an extra layer of scrutiny because of insider information or non-public kind of material information. So there, in these cases, this is where somebody in that position can set up what's called a 10b5-1 plan.
That's a really important point. Let's talk about that because I don't know that a lot of people are aware of these plans. Why don't you explain how it works?
Yeah, so this is really just a plan that somebody in a call it a executive level position with a company that is acquiring stock, they can set up a plan to establish a preordained kind of sale of their stock. So they put these plans into place when there's kind of an open trading window, when there's not a blackout period. But essentially, they're saying is they're just essentially
If this happens,
agreeing to sell the stock so
I'm going to
that
sell.
if there's a blackout date or should they come into possession of information that is of sensitive nature, well, they already had a plan in place before that occurred, so they
Nobody could accuse them of using non-public
so they
information.
have basically a valid defense there that they can essentially sell the stock.
We
and
don't
not
want
be-
any Martha Stewarts here.
No,
Thank you.
Yes, it gives them what they call an affirmative defense, so
Right.
they can't be accused of insider trading. So, this is a great way if you're an insider, where there's an issue there, where you can set up a plan to sell the stock and gradually divest and protect yourself legally,
Okay.
as well. But selling's the easiest way. We operate in a world of liquid markets where you can sell, so that's usually the easiest way to solve the problem, and if usually you do it over
Right.
time. But other way is to diversify, and there's a neat little way that you can do this. It's something called
Oh yeah, this is great.
an
The
exchange fund.
Yep.
This is a fund that's specifically set up to kind of solve a common problem that people with concentrated positions have. So you might have, let's say, Apple. I might have NVIDIA, and somebody else has Broadcom or something like
Yeah.
that. Those are kind of the big popular stocks. But all of us have the same issue of concentration. We have the same issue with this enormous tax bill, and we need diversification to reduce the risk. So an exchange fund is really put together by a sponsor like a Goldman Sachs or another big institution, but it allows everybody to contribute that stock.
So they're creating a pool of investments of different securities. Now they have to accept your stock. If they already have a bunch of Apple, they're going to say, "No, thank you, Patty. We already have plenty of your stock." Right? So the sponsors are looking to diversify out of the concentrated risk, but it's a wonderful tool so that you get to participate in the stock as well as other company stocks and not have the big capital gain.
Yeah, and I think there with these funds, again, these are unique. You have to be accepted, and there's other rules and criteria. So again, in full disclosure, you always have to understand everything in terms of the restrictions and requirements there. But it's just a great way for somebody to diversify a stock that for one reason or another they can't get out of or they're not likely to sell. And essentially the pool just tries to resemble kind of the S&P 500, if you will. But in most of these, after 7 years, you get back the value of your investment, but you get back all the shares in the pool, not just your concentrated stocks.
Which is
so you kind of get it's a way to kind of diversify a concentrated position, but not sell and trigger the tax that's due. So So that's an interesting way in terms of what you could look at.
How about for those people who are charitably inclined? Really neat tools out there. The government is, they're giving all of us an incentive to donate to charity.
Yeah, and I think that to me
Mhm.
is the ultimate home
Yeah,
run.
yeah.
I think in a situation like this. So if somebody has the means and the inclination to do charitable giving, appreciated stock is
Oh,
the best
100%.
tool,
Yeah.
to do this. So we come across people all the time that they give donations of cash, not
Yeah.
realizing, hey, why don't you give shares of appreciated
Yep.
stock? Because not only do you get the same tax write-off,
Yeah.
assuming you can
You still get
itemize,
yeah.
but the charity doesn't pay the tax on the capital gain,
Right.
or using some of these other methods like charitable remainder trusts.
Oh, that's a wonderful one too. You put the stock into the trust, and it creates, and as part of the agreement, right? At the end, the charity is going to get whatever's left in the trust, but in the meantime, you get a dividend each and every year. Let's say it's a 5% payout. Every single year, you're getting 5% of whatever it is that you put in. So it's a wonderful way of accomplishing your charitable intent,
Mhm.
saving a lot of money on taxes, and diversifying around. Because again, once it's in the trust, you can sell the stock. There's no capital gain.
Yeah, and I think that's the really powerful
Yeah.
incentive there is that, those benefits, and you get to know that you're benefiting, a
Mhm.
cause that's important to you, and you're not relinquishing the income properties of the
Right. The
of the
underlying.
investment
Right. Exactly.
and so forth. So I think
Mhm.
that's a great strategy
Yes.
too.
One thing, Eric, if I can go back to the exchange fund, before you do some of these tools, you have to make sure you run your numbers to make sure that you're still going to be okay. Because once you do it, for example, if you put money into an exchange fund or you put money into a charitable fund, that money is there and it's an irrevocable gift. You better make sure that you're not going to look back 5 or 10 years from now and say, gee, I wish I hadn't.
Mhm.
That is the worst outcome of all. So let's not let the tax tail wag the dog too much and understand what you're getting into.
Yep, absolutely.
All right, so we talked about you could sell. There's lots of different ways to do it to minimize the taxes. We could diversify through an exchange fund.
Mhm.
You could give it to charity,
Mhm.
either outright or through a donor-advised fund or a charitable trust of some kind. What's the fourth way? It's hedging. So we talk about hedging. I don't know about you, Eric. I kind of think about hedging as a very short-term strategy because it's very complicated and it's a lot of money. It's costly to do these, protective puts. Basically,
Yeah.
with a put, you own the stock. It's $1 million, and you basically buy a put to say, okay, well, if I don't want this anymore, I'm going to put it over to you,
Mhm.
right? Meaning you're getting rid of it. So that's fine. It sounds wonderful, but they're expensive and they're complicated. They're usually short-term strategies that you have to re-up for every 3-6 months or so.
Yeah, and I think the key there that you highlighted is that it is a very short-term thing. So if ultimately the easiest way to reduce the risk is just to sell it. But if there is a period of time where you are
Mhm.
worried or want to
Yeah.
protect your position, then hedging can work. But to your point, there is an explicit cost to that. Just like we pay premiums for our homeowners
Yes.
insurance
That's
or
what it
life
is.
insurance.
It's insurance.
It's the same thing here. You are paying a premium to provide a floor to
Mhm.
kind of lock in a sales price. Now, there's various ways that you can subsidize that
Yeah.
premium. There
These
are
are pretty cool.
yeah, there are things like protective puts that you can put in place, or what they call vertical puts, and also stock collars are very common. It's a way to kind of box in
We
the
did
price to
that.
put
Yeah, that was a great strategy we did for one client.
a ceiling and a
Fantastic.
floor around it.
Mhm.
So essentially, the stock can just kind of move within this defined range, but you're essentially
Protected.
setting parameters around it. But again, I think hedging is a very short-term solution on an ongoing basis. It is costly to do, and it's also very labor-intensive because you have to
Mhm.
continually
Yeah.
readjust the hedge to provide the level of protection that you're looking for. So again, I think short-term strategy,
Okay.
is the key there.
hmm Okay. Let's kind of wrap this up and
Right.
really let's put a human element to all of this. So when we think about this risk, I think about risk in terms of everybody thinks about risk of loss of principal, loss of money.
Mhm.
I care more about the risk of a loss of your lifestyle, right? You know, always answering the question, are you going to be okay? Taking into consideration taxes, inflation, things of that nature. Is it worth risking your ability to live your life the way that you want to just because you want to hold on to one stock? I'm not sure, but you got to run the numbers. If it happened, would you still be okay?
Yeah, and I think that's the key phrase, am I going to be okay? Which, by the way, somebody wrote a book called that. But how often do we come across that in our daily
Yeah.
meetings with clients?
Every day.
Each and every day. But I think that's the biggest thing is, is this possibly jeopardizing your lifestyle? And to me, that's the true definition of risk is could it cause a change in your lifestyle? So I think you hit the nail on the head there, and I think that really taps into the human element
Yeah.
of what's ultimately important, which is financial security, long-term, durable
Exactly.
financial security.
Exactly. Durable financial security with removing or reducing the risk of ruin.
Mhm.
That's what we want to avoid altogether. Or to put it in real terms, of you becoming dependent on someone else, like your children. Nobody wants that, right?
Yeah.
So let's make sure that that doesn't happen. Let's do everything that we can to preserve your lifestyle. That's what it's all about.
Yeah, and I think the other thing too, as we kind of dig into this with individuals that are in this position, is that the more you talk about it, the more you realize that there is not necessarily structure. There's not a strategy in place. If you have somebody with a concentrated position, well, when do you know that it's time to sell?
Mm-hmm.
What happens if the stock drops 30%? What do you do then? And I think the trouble with the market is that we're always taught that investments have unlimited potential.
Mm-hmm.
There is no cap
Mm-hmm.
to how high the price can go.
Not all stocks.
Yeah, but there's that old German proverb that trees do not grow to the sky. And what that tells me is that essentially there are limits on growth. This idea that things can just go on forever, unlikely. But the trouble that you have is, unlike sporting events or games of skill and things like that, or games of chance that you might see, there are rules, there's structure.
Exactly.
There's a start time and then there's an end time. There are rules for how things work. You have to actively participate, and then the games end and you're out of it. In the stock market,
It's
there is no
unstructured.
end.
Right. No
Right.
rules.
Like, yes, every day the stock market closes, but essentially there's no end date for that. It goes on forever, and each and every day prices gyrate up and down. Things are going to change. But ultimately, in order to hold this position, most people don't have a set of
strategy.
rules. And even if they have rules, the human tendency is to modify the rules
When things are happening.
as things go on.
Oh, my goodness.
And I think the big thing here is that most people don't have a sale price target. They don't have a plan B if suddenly it
Right.
opens up 20% down because of
Or
some piece
what
of
happens if it goes up 30%? Are you still going to hold it then?
Right.
Right? Or are you going to look at it and say it's going to keep going?
Yeah, so I think the biggest thing there with anybody is just like to begin the conversation is just saying, okay, do we have rules? Yes or no? Are they written down? Are they quantifiable?
Right.
And if there's not, then at least let's start with some rules.
Yes.
Of engagement.
Mm-hmm.
How are we going to proceed? And then hopefully from there,
Yeah.
that softens the ground
Yeah.
to begin to.
You know what
start
I find,
addressing the
Eric? I
position.
find just asking people one question really just solves the problem. And I basically say, okay, let's pretend for a moment that you have $1 million of cash. You have $1 million. My question to you is, would you take that $1 million and buy that stock that you have $1 million in? That will tell you. If they say, yes, I would, then sure, go ahead and keep holding on to it. If they say, no, I wouldn't take $1 million and buy this stock, then why are you holding it?
Yeah.
Because it's the same decision.
Yeah, really, that's a great way to kind of really hold the mirror up and look
Exactly.
yourself in the eye and say,
Right.
what's on the inside there.
And the other thing that you brought up that I think is so important is that people don't know until they're in it. I'll never forget, during the tech bubble, financial crisis, we would get people who would call, and most of the time they were in a panic and they wanted to sell. Sell, move to cash. This is going to be awful. I'm going to lose everything. Yep. And most of the time we were able to kind of walk them off the ledge. However, and I think I might have shared this before, but there were 7 people who I was able to say, okay, let's not sell all. How about we do half? And they said, okay, we'll do half. So we sold half the portfolio in all 7 cases. And I literally wrote down what the Dow was, the S&P was, and NASDAQ on the day that we did that. And then I just waited. And not once, not twice, but Eric, all 7 clients. When the market, and by the way, when we sold it, the market kept on going down. So they felt like they made the best decision ever because during that period of time they had. But when it bottomed and it started to rise, right? They were rising, they were back to even. When do you think that they called? They called when the market was much higher than what it was when they sold. And they were in a panic also. Hurry up, get me back in, get me back in. And it was, we talk about opportunity cost. They lost that money. First of all, some of them had to pay taxes, but even if it was in a retirement account, okay, so you're not paying taxes, but you still lost the difference between the price at which you sold and the price that you were getting back in. Because people say, I want to sell now and wait until things get better.
Right.
Well, how are you going to know when they're actually better?
Yep. Yeah, which sounds a lot like market timing to me. Which
Yes, it does.
Yeah, which we definitely do not advocate.
Yeah, and how often do we see head fakes? Market goes down, it goes up, and then it goes back down again, right? So it tests the lows. That's all part of this process. Sometimes it doesn't test the lows. We don't know. So let's not guess. Let's figure out what you need and when you need it. And then if you want to hold on to the balance, fine. It's your money. Do what you want.
Yeah, and I think that's the other part. You said head fakes, or that might be another way to describe correction, which is that technical term we use. But, if you look back at the market, 8 to 10% declines happen almost every year.
Yeah,
You know what I mean?
absolutely.
Almost
Sure.
every year. So they happen all the time, despite the fact that the market recovers and usually, for the most part, goes
And
on
here's getting back to the reason that we're talking today. Here's what people go to. Well, it's going to recover. It's going to come back when they see their individual stock go down because they see that the market recovers, right? Well, not all stocks. There's a saying, you never want to catch a falling knife because it could keep on going down and down and become worthless. So many companies have had that outcome, and the people ended up with nothing.
Yeah, and I think that, again, that just goes back to the research, which is, what does the actual research tell us? And the vast quantity of stocks, many of them, lose value, and
You don't want to lose
don't come
everything,
back.
that's for sure.
Yeah. So
And yes, I understand that the stocks are paying a dividend. Is that dividend sufficient to carry you for the rest of your life after inflation and after you pay the taxes on it? That's really the question. Again, it's about you. It's about your lifestyle. And if you'd be okay, then fine, great. We'll have at it.
Yep.
So,
Yeah.
and really, it was interesting because I had a conversation about legacy and how you want to think about also the impact that could have on you, on the people that you leave behind, children, grandchildren, and the wealth creation over time. So having it all in one stock, sure, or you could be the next Bezos or the next Elon Musk or all these people, but really, what is the probability that that's going to happen?
yeah, probably not very good.
Right.
It's the needle in the haystack.
And sure, NVIDIA's happened, and they're going to continue to happen. But who would have thought, right? I think it was NVIDIA. I think it was during during COVID when it crashed. And we got a call from somebody who had so much in NVIDIA, and he was losing it because that's where all of his wealth was. So he asked me what I thought he should do. And I said, I can't answer that question until I understand what your goals are, what you want for your family, etc. And never heard from him again.
Yep.
But you know what? I did the right thing because that's the right answer.
Yep, absolutely.
So, Eric Furman, thank you once again for a wonderful research project. We're going to have a planning lab on this topic also because I think everybody here at Key Financial, internally, externally, all of you are now experts on concentrated stock positions and also know what to do. Don't let emotions, don't let sentiment take you down. That's the only way I would summarize all of this.
Yep, well said.
Good. Thank you so much for joining us today. I'm Patti Brennan. Eric Furman, thank you for joining us. I hope you found this helpful. If you have any questions, go onto our website, ask your questions. This is why we do this. We want to make sure this is of value to you. Thanks so much for joining us today. Have a great week. Take care.
The following presentation is sponsored by Key Financial Incorporated. The Patti Brennan Show is intended for general information purposes. Only any non-employee guest speaker who joins Patti Brennan on the show is a guest and is not an affiliate of Key Financial. Their remarks do not necessarily reflect Key Financial's opinions or positions. Key Financial neither prepared nor verified any portion of our non-employee guests' presentation content and has relied upon the accuracy thereof. No portion of the presentation serves as the receipt of or a substitute for personalized investment advice from Key Financial or from any other investment professional of your choosing. Neither the information or opinions contained in this or any podcast, white paper, or on Key Financial Inc.'s website constitutes a solicitation for the purchase or sale of any securities and should not be relied upon as financial, legal, or tax advice. Content may be outdated, and past history is no guarantee of future results or experience. Please seek appropriate counsel from qualified professionals who know and understand your goals, objectives, and potential vulnerabilities. Thanks for listening to The Patti Brennan Show, brought to you by Key Financial Inc., wealth management with wisdom and care. Securities offered through Osaic Wealth, Incorporated, member FINRA SIPC. Investment advisory services offered through Key Financial Incorporated. Osaic Wealth is separately owned, and other entities and/or marketing names, products, or services referenced here are independent of Osaic Wealth.